Disney is down 25% in the last 1 year. Guys, on March 8th, 2021, a year and a half ago, it was at $203. It is now at $82 per share. The whole negativity around Disney is huge. And full disclosure, I've been buying. So again, don't buy just because some guy on YouTube does it. I'm here to teach a process. I'm here to make you smarter. I'm here to help you become the smartest of all your friends, to understand the financials of a company and understand that when the stock falls, but the financials are still intact or not down as much, you find that as an opportunity to buy. So I appreciate you watching this video. In this video, there'll be something for beginners and for more advanced investors and everything in between. The further we go along in this video, the more valuable the information is. So stick with us the entire time. We're gonna go over some news about Disney. We're gonna go over some high-level metrics. We're gonna cover some bull and bear cases from our community. We put it out there in the community, very busy, a lot of bull and bear cases. We're gonna go into there. Of course, we're gonna cover our 8 pillars, and we're gonna finish it off with our stock analyzer tool. That's going to tell us, based on our assumptions, what's the right price to pay for Disney today based on those assumptions. So let's go check this out right now. So Disney today is down 3%, down to $82.33. The company is currently a $150 billion market cap. That means if you wanted to buy all the shares outstanding in the market, that's what you got to pay. Now, it's been hit hard by COVID, okay? So the net income in the last year was $2.25 billion. The free cash flow was $586. The 5-year average net income was $3.5 billion with $2 billion in free cash flow. So I don't like the fact that free cash flow is so much lower. And the PE here is 67. That's really high, right? But I want to show you something. That 67 PE is based on $2.25 billion in net income. Let's go to before COVID. Before COVID, the company was making 12.3, 12, 9, 9.2, 8.3, 7.4. These were the previous 6 years before COVID. Just increasing every single year. Then it plummeted. Now, the weird part is this. Look at the revenue. They're at record revenue. $87.8 billion in revenue last year. So the question you have to ask yourself, that the reason I've bought Disney, again, don't buy it just because I'm buying it. You have to do your own research, and we're here to teach a process. But I'm looking at it saying, are their margins going to come back? Why would their margins stay this low forever? The margins right now are 3%. But before COVID, they were at 20%, 15 to 20%. So let's just say the average is 10%. Is that a reasonable multiple to pay? Is that a reasonable profit margin for Disney? I don't know, but that's the question here. And remember, profit margins are going to fluctuate over time. I'm hoping this is a temporary thing for Disney. Could it be permanent? Absolutely. But my bet is based on it being a temporary, short-term drop in profit margins. All right. So Disney's not paying a dividend, obviously. And their gross margin, though, 47.5%. That means for every extra dollar they sell, 47 cents of it goes to the bottom line before taxes. That's an incredible number for such a high business. Now, a couple pieces of big news about Disney. One, they just announced they're spending $60 billion in their parks in the next 10 years. That's $6 billion per year. Parks are a big chunk of their revenue. Big chunk. It's like 40% of their revenue. The streaming service, still struggling a little bit in terms of profitability, but it's huge. Bob Iger just came back on board. So let's check out what our community is saying about the bull. So I'm going to go to the EM community chat. I'm going to go scroll down and find Disney right here. Oh, wow. A lot of comments. Okay, Petro, bull case for Disney. For starters, it's priced at their 2013, 2014 lows. Get that. I get that, Petro. But remember, you want to sit there and make sure the valuations back there were still reasonable. But I like what you're going there. They've grown as a company since then. This is subjective, but they own ESPN, which is a huge going forward, having live sports, including Disney Plus bundle. Now, there's talks of them selling ABC and ESPN and focusing more on Disney. So that's something to consider. Let's see what else they got. Oh my gosh, look at this. The companies Disney owns. Geez, oh, Pete, I didn't even realize that. That is complicated. And if you're in our community, go into the Disney chat so you can pull up this chart, because I think this is a great chart for Disney. AMW, DeSantis can only be governor for so long. That's funny. All right. Dan H. I hate the film industry, but it's Disney. If they get back to pre-pandemic margins and ROIC of 18%, this is a screaming deal. I just think that the debt is going to eat a lot of the profit. Very well could be for the next few years. Profits skyrocketed from 9 to 23% in 2009 to 2019. Look at that. That's a very important aspect. Dan is right. if the numbers get back, if just the margins get back to even close to pre-pandemic levels, this is a screaming deal. And Dan, like usual, puts in his stock analyzer tool, which I love that people share that in the community. Let's see, bull case, they have record revenue. So let's just convert that over. Raf says, diversified entertainment conglomerate with a wide range of business activities, owning many different brands. Entertainment and media industry typically has high barriers to entry. He's 100% right. High barrier to entry. That's a moat status for Disney. Can you go right now and spend $10 billion building a theme park that's going to compete with Disney? You don't have the Disney characters. You don't have the history. You don't have all those things. This is a very, very large moat. So that is part of my big thing on Disney. Vast content library. Bear. Rivalry with the entertainment media industry is intense. That's true. Major competition from Comcast and Netflix, Amazon Prime. Let's see here. With so many different brands, hard to integrate everything. Perhaps Disney's success is tied to performance of key franchises, which could suffer from fatigue. However, I do think that's unlikely. That is a valid point, though, if people are just overdone with the branding. Yeah, Disney revenue can be badly affected by park closures, which could be due to diseases like COVID or naturally occurring disasters like hurricane. Yeah, but we've had that for a long time. Now, granted, COVID was an extreme case of closure, but still, it was important to understand. Oh, great comments here, Raf. Great comments. Sorry I got carried away a bit. Please get carried away. Wicked Willie, our in-house analyst, announced transformative agreement with Charter Communications for distribution of linear networks. Don't know what that means. Oh, launching an ad-supported subscription model in many countries in Europe and Canada on November 1st. Two bear cases. Foot traffic at Disney parks, according to UBS evidence, saw a 23% fall in the most recent quarter. That ain't good. And overall tourism in Central Florida is down, evidenced by a 6.7% year-over-year reduction in its tourism development tax, which is collected on income received from short-term rentals to include hotels. That is not good. Keep in mind, though, they still have California, Disneyland, and they have Euro Disney. Very popular. Pietro writes, I think Disney's media has a huge bull case. I agree. It's deep. They bought 15% MLB, a DTC sports business, direct to consumer. During the 9 months ended July 1st, Hearst Corporation contributed $710 million to the domestic DTC. I wonder what that's all about. I think the biggest question to answer is, can Disney go back to their historical margins? Yeah. I think that D-Money, I think that's exactly the question to ask. I've owned it and sold it. They have one of the mother of all moats, as others have said they have built in diversification. Yeah, so guys, I think a lot of it, fundamentally goes back to that. Great comments. And by the way, Raf, great comments here. I love that you got carried away. I'm going to give you a free t-shirt. Email us at help@everythingmoney. Pick out one of the t-shirts and we will hook you up. So thanks very much for the comments there, everybody. And Raf for being so thorough. All right, let's check out the 8 pillars on Disney. Now remember, guys, if you're part of our community, you can customize your pillars up to 12 different pillars. But guys, look how ugly this is. The only thing up is revenue. This is definitely, it's essentially a turnaround play, even though their revenue is record. The question is, can they get their costs in line? If they can get their costs in line and margins back to pre-pandemic levels or anywhere close to it, I do think this is a no-brainer, right? But it's all ugly here. Now remember, the 8 pillars that tell a story. You're not supposed to buy or sell based on number of pillars that are check marks and X's. It's about telling a story and asking questions. All these questions are answered with one thing, COVID. But the next question is, can they get back to it? Can they get back to the pre-COVID levels? All right, let's see what analysts are saying about the Disney company. So they're expected to make $3.76 per share this year, going up to $9.13 according to analysts by 2028. So the current stock price is 82 divided by 9. It's selling for about 9 times 2028 earnings, which is pretty far out. But the question is, can they still do well with this thing? Can it get better than this? I don't know. At $9 per share in earnings, assuming their shares stay the same, that takes them to, they have 1.83 billion shares outstanding, times $9.13, $17 billion in profits. That the analysts have them getting back to pre-pandemic levels. And then if you're willing to pay something like $20 a share for a company like Disney for its moat, that's $180 a share. I don't know. Maybe would you pay $83? If you believed all this, would you pay $83 or $82 today for a company that might be worth $180 in 5 years? It's a pretty good return on your money. Again, it's not a guarantee, but it's a simple process. Disney has a history. It's not like we're looking at a company going, hey, what's the history here? Do they even have a moat? Disney is a moat. Their market cap's $150 billion. If I gave you a $150 billion check today and said, go compete with Disney, you would not be able to. Imagine that. I write you a check for $150 billion and say, go replicate Disney. You would not be able to. They have 100 years of history. They have all these brands. They have Cinderella. They have all these things. My nieces still watch the Cinderella, the Snow Whites, all these things, Beauty and the Beast. They were born in 2018 and 2020. That's amazing. All right, so let's look at their revenue growth potential, according to analysts. Expected to do $90 billion this year, growing to $118 billion in 2028. So that takes them to, according to analysts, $16 billion in profit on $118 billion in revenue, which is roughly 15% margin. So like I said, can they get back to that? If they can get back to that, I think people are going to be very happy they bought the company. But again, the question is, will they get back there? All right, so now, guys, you have to ask the question, what's the price to pay for Disney? So that's why we have the stock analyzer tool. This is our tool that's been used over 2 million times since we started paying attention. But before I get into it, I just want to explain one thing to you. Guys, a few weeks ago, things really changed for me. So you're sitting here watching this video, which tells me you're one of the elite people who want to understand financials and want to understand investing. So a few weeks ago, one of our most active members of our community, in our community here, wrote me an email thanking me for the software and how it changed his life, which is awesome. But one of the things I got from him was he sat there and said, Paul, when you were charging $30, $40 a month, I didn't really want to test the software out. But then you offered $7 for 7 days. And I was like, listen, let me give it a shot. Changed everything for him. He had peace of mind. He had increased status amongst his friends. He was a smart guy. He loves that his friends look at him as the smartest guy that they know about money. But he said to me, Paul, I think you're missing out on a lot more people like me. He actually went a step further and said, I think you should give it away for 7 days for free. And I thought to myself, I don't know if I want to give it away. And then I thought to myself, you know what? Let's give it a shot. Let's go out there and give full access. So now, guys, click the link below. You get full 7-day free access to the entire community and the software, all the tools involved here. If you look at all these tools, all of these you'll get full access to. Full access. I'm not holding anything back. I am that confident that at the end of 7 days, it'll change the way in which you look at money. It'll change the way in which you understand investing, and it'll change the way in which you appear to all your friends and family. You are going to be the expert, and this software allows you to do that. So go now, sign up, everythingmoney.com/sign up. Go sign up for a free 7-day full access trial. Okay, now, back to our analysis. Now, guys, I'm going to pull up Disney in our history of our stock analyzer tool. And the last time I did it was August 14th of 2023. I did a 10-year analysis, and guys, look at this. Their 10-year ROIC is 7.2%. Obviously, it's declined because of COVID. It's been really bad. But they had to take on more debt. There's a lot of things that are going on there. I'm not as worried about this. That doesn't concern me as much because there's a story behind it that makes perfect sense. So let's look at my assumptions here. For revenue growth, low, middle, and high assumptions, I did 3%, 6%, and 9%. I think that's pretty reasonable. Even analysts seem to believe that that's probably reasonable. Now, I will do this. I might change this to 2.5, 5, 5.5, and 8.5. Just to be a little more conservative. Now, profit margin. Guys, I did 6%, so they just get a little bit better than they are today. 12%, which is still below their pre-COVID levels, and 18%. Because with streaming and things like that, and that's such a high margin business, if they figure out how to make it very profitable, can they get there? Sure, maybe so. All right, free cash flow margin. I like to just keep it the same. Over long periods of time, free cash flow and net income should be the same. And taking out these 2 years, these two metrics, I think over long periods of time, their free cash flow and their net income was pretty similar. Now for PE, you're looking at PE, you're seeing 67 and a price of free cash flow of 257. What we need to put in here is where do we think the PE and price of free cash flow will be in 10 years, at the end of 10 years, at the end of our analysis. Now guys, when you look at PE, what I like to do is I like to start at 15, the historical average, 15 or 16, go up when there's a high moat, a lot of revenue growth, and a high ROIC, okay? and go the opposite when the opposite is true. So go lower when the opposite is true. I think Disney is a moat. I think it justifies easily a 20 multiple on earnings and free cash flow. So I put 17 on my low side, 20 in the middle, and 23 on the high. Listen, all of these numbers are based on your assumptions. These are probably the hardest ones to come up with, and that's why in the community, I always see so many messages going, what do you think for a multiple for this company? Because it really, look at Warren Buffett. He paid 30 times multiple for Coke in 1987 when he first started buying Coca-Cola. But his comment was, it's a huge moat, and if prices go up 10%, people are still buying it, and there's a lot more people in the world that need to drink Coke. So I'm fine with 17, 20, and 23. Now, for desired return, you can get 9 or 10% over long periods of time by buying a long-term ETF, low-cost ETF. So the question is, what return do you want to own this individual company? And as your assumptions get higher, you need to increase your desired return, which increases your margin of safety. So I put in 10% on the low side because I'm okay making 10% if all these low assumptions occur. I'm like, listen, I bought Disney, made 10%, and they didn't do well. I'm fine with that. But I want 12% and 14%. I'm actually going to change this. I'm going to put 12.5 in the middle and 15 on the high. Because I do think there's still some issues for Disney they need to work through. So I'm okay I want a little bit higher return in the middle. And these levels I think are going to be very difficult. So I really need a much bigger return to get there. So guys, I'm going to hit the analyze button. I just need you to stick around with me for one more minute while I explain the numbers. Because like I've said to you many times, I'm here to teach a process, not give you, I'm not just here to tell you, go buy this company. First off, that's illegal. But secondly, I'm here to teach a process. So I want to explain these numbers to you. I hit the analyze button, boom. So a low price of 43, a high price of 170, and a middle price of 100. If you paid today's price of 82 and the lowest assumptions occur, you're gonna make about a 1% return. If the middle assumptions occur, 15%, and if the highest assumptions occur, 26%. Guys, thanks very much. Again, 7 days for free, full access to our software. Click the link below, go to everythingmoney.com/sign up. Take care.